Morning, everyone. So welcome to our 2017 results presentation. So I'll kick off with a review of our operations and the business, and then Dan Jones, who's our interim CFO, I'll welcome him to the presentation. We'll deliver talk about our numbers, and then I'll come back and review how we're doing on strategy. So I'm delighted to be here for my first set of results as the Drax CEO. Let me tell you how I see 2017 for the group. Drax is continuing to transform itself from the largest coal-fired power station in the UK to an integrated low-carbon energy company. During 2017, we made progress across all areas of the business, strategically, operationally, and financially. Today, we are confirming our full-year dividend of £50 million, as well as announcing that we are commencing a £50 million share buyback program, as is consistent with our capital allocation policy. This decision is a strong indication of my and the board's commitment to a strong balance sheet, investing capital for growth, and delivering cash returns for shareholders. We achieved several milestones in 2017. We acquired and successfully onboarded Opus Energy. Evidence of that was our delivery of 29 million of EBITDA in line with our plans. We acquired LaSalle Bioenergy and began commissioning in November 2017, which was 2 months ahead of plan. We received government support for the conversion of a fourth unit to biomass. And we positioned ourselves well for future investment in gas generation as we progressed the repowering at Drax Power Station and our options to develop 4 new OCGTs. While we did not receive a contract in the latest capacity auction, we intend to enter 2 of the projects in the auctions coming up in December. Financially, we delivered 229 million of EBITDA, a 64% increase on 2016, and delivered very strong cash flow. We refinanced the company, and net debt was well inside our target of 2 times EBITDA. And this allows us to deliver a growing and sustainable dividend and the aforementioned share buyback program. At our Capital Markets Day in June of last year, we laid out our ambition of delivering more than 425 million of EBITDA by 2025. Importantly, we intend to do so while also delivering significant returns to shareholders. This will require operating safely and sustainably across our business. It will also require operational excellence to deliver growth in organic cash flow. And finally, it will require prudent investment. And we believe we have attractive opportunities to do so across our business. Let me remind you of how we intend to do that. First, by achieving our goal of 30% self-supply, we expect to grow the EBITDA of our pellet production business to at least £75 million. Secondly, as we move off coal, we're adding a 4th biomass unit to our generation business. When combined with our options to develop gas-fired generation, we expect to deliver more than 300 million of EBITDA from our power generation business. Finally, we expect to continue growing our B2B energy supply business, as it has done over the last decade, to achieve at least 80 million pounds of EBITDA. We made an excellent start towards delivering those objectives in 2017. Financially, we delivered EBITDA of 238 million in power generation, 29 million in B2B energy supply, and 6 million in pellet production. We also made progress on our strategic targets. We purchased and commissioned LaSalle Bioenergy, moving to 1.5 million tons of capacity, relative to our goal of approximately 30% self-supply, or 2 to 2.5 million tons. We worked with government to get support for the conversion of Unit 4 to biomass. And we purchased Opus Energy and delivered on our first-year business plan. At the same time, we successfully managed our balance sheet so that net debt was 1.6 times EBITDA, allowing us to announce today a £50 million share buyback and deliver on our commitment to deliver returns for shareholders. Let me move on now to the operations and business review. Safety and sustainability are at the core of what we do. We work in challenging environments. Both coal and biomass must be handled carefully or they can pose significant safety risks. We had a small fire in our biomass handling facilities at the power station in December. Most importantly, no one was injured in the incident. While this limited biomass operations on 2 units for about 4 weeks, the team at the power station worked very well to both mitigate and then repair the damage. And overall, our safety record continues to be outstanding and in line with prior years. The biomass that we use must be sourced sustainably to ensure that it delivers the appropriate level of CO2 reduction, while at the same time, we support the habitats in which we operate. And we continue to deliver on our commitments to sustainable biomass. Corporate responsibility is important to us. We have recently become a member of the UN Global Compact, and we have significantly increased our reporting on sustainability on our website. By continuing to work safely and sustainably, we're building a long-term business that delivers growing returns to shareholders. In 2017 was a transformational year for Drax Biomass. For the first time, we delivered positive EBITDA, £6 million, which is a £12 million increase on 2016. We increased our production by 35% to 822,000 tons, and during the fourth quarter began producing consistently at nameplate capacity at Morehouse and Emite, our first 2 plants. We also completed our dry shavings projects on time and to budget of £10 million, increasing capacity by 75,000 tons at each plant. These projects also help us significantly reduce the cost of production, thereby moving us towards our long-term target of making biomass viable without government support. We purchased and successfully recommissioned LaSalle Bioenergy. The total investment, including upgrade, of £50 million is approximately half the cost of new build plant. We are already ramping up and on some days are producing at levels close to our other plants. As a result, we now have about 1.5 million tons of our own capacity, closing in on our target of 2 to 2.5 million tons, or approximately 30% of self-supply. We will continue to develop projects to expand our capacity at our own sites. These projects have excellent returns and have the added benefit of reducing our pellet production cost. And we will also look opportunistically at acquisitions. One final note. In January, I made the decision to move our U.S. headquarters from Atlanta to Monroe, Louisiana. We already have a regional office in Monroe, which is located close to our 3 existing plants in the U.S. Gulf Coast. This was not an easy decision to make, and we will treat all our people fairly, and I'd like to thank them for their contributions. The change is driven by our desire to promote efficiency and reduce cost to help achieve our long-term goal of making biomass viable without government support. Looking into 2018, our goal in pellet production is to continue growing towards our nameplate capacity of 1.5 million tons. 2017 was an excellent year for Drax Power. We delivered a £64 million increase in EBITDA, largely the result of having the CFD for a full year. We continue to be the UK's largest single source of renewable energy at 13 terawatt hours, a small increase over 2016. Importantly, this represents 65% of all of our generation, and today coal-fired power sales are just 9% of the group's revenue. We play a critical role in supporting the UK power system, as demonstrated by the £88 million that we generated from system support and flexibility. Looking into 2018, our goal is to continue driving operational excellence with high biomass availability to generate the necessary baseload power for UK security of supply and flexible coal to support the system when needed. As always, safe operations throughout the plant are a top priority. 2017 was also a transformational year for our B2B energy supply business. For the first time, we delivered positive EBITDA, £29 million, a £33 million increase on 2016. Both Haven Power and Opus Energy delivered positive EBITDA, and we increased meter points by over 10% to 375,000. Opus Energy delivered in line with plan and began the journey to realize the key financial synergy of the acquisition by insourcing both electricity and gas supply. Opus also was named Utilities Provider of the Year at the British Small Business Awards, a great achievement in a year of significant change. The energy supply market continues to be in flux. In the B2B sector, we have an ongoing opportunity to grow our market share whilst retaining our strong margins. At the same time, we look forward to completing our system implementations at Haven Power, which will enable us to drive down cost over time. This is the first step in building a consolidated B2B energy supply platform. Now I will turn it over to Dan to go through the financial review.
Thank you, Will, and good morning, everyone. Will has given you a good summary of the company's businesses, and I'll now go through the numbers. So, financial highlights. We have delivered a strong financial performance and for the first time positive EBITDA from all three parts of the businesses, which together have delivered 229 million of EBITDA for the group. This is a significant improvement on 2016, an indication of the progress we have made in delivering the group's strategy. This strategy is leading to higher quality earnings with reducing exposure to commodity markets and opportunities for growth across the group. In this regard, I'd like to note that our EBITDA expectations have remained broadly unchanged throughout 2017, an indication of those higher quality earnings coming through. To support the strategy, we also completed a refinancing of the business and announced a new dividend policy which will pay a sustainable and growing dividend. The full-year dividend for 2017 is £50 million, 12.3 pence per share. This is a level which is sustainable through the business cycle and which we expect to increase as the strategy delivers higher levels of EBITDA and cash in the future. Our balance sheet is strong, with cash in hand of 222 million and net debt of 367 million. This is a lower level of gearing than expected, reflecting strong cash generation, strong cash management, and strong financial discipline. As Will has previously highlighted, reflecting this result and our capital allocation policy, we plan to initiate a 50 million share buyback programme. Finally, underlying earnings were 0.7 pence per share, in line with consensus. Okay, moving on to the detail in the income statement. Revenue growth principally represents the acquisition of Opus Energy and renewable support under the CFD mechanism. I'll come on to the components of EBITDA in the next slide, but below this figure, firstly a charge of 182 million for depreciation, amortisation and disposal. Of this, depreciation and amortisation was 166 million, up 57 million year on year, principally reflecting the accelerated depreciation of coal-specific assets, as well as a 37 million amortisation for the newly acquired intangible assets in Opus Energy. We also incurred a charge of 15 million in relation to losses on the disposal in the ordinary course of business and the sale of Billington Bioenergy. Net finance costs of 42 million, reflecting interest costs on a high level of debt and movement on foreign exchange balances. The small underlying tax charge includes a one-off non-cash charge of 16 million associated with the reduction in US federal tax rates from 35% to 21% following the revaluation of our deferred tax balances. Now, this is netted off by a cash credit of 13 million from the UK Patent Box tax regime. Further benefits from this regime we will receive in 2018. Together, this leads to underlying profit after tax of 3 million compared to 21 million in 2016. Now, I'll come on to cash in more detail, but to summarise again, the balance sheet is strong, net debt of 367 million, which is below our target of 2 times net debt to EBITDA. This reflects very healthy cash generation from our core operations and working capital inflows. Our operating cash conversion has been around 65% for the last 2 years and will continue to increase as the energy supply and pellet production businesses contribute increasingly to EBITDA. Okay, I thought it'd be useful here to provide a year-on-year bridge for EBITDA, which has increased by £89 million, with significant improvements across all 3 areas of operations. A full income statement is included in the appendix, but in summary, power generation was up 64 million, benefiting from 1 unit operating under the CFD mechanism, which helped offset a reduction in achieved seasonal power prices. And ancillary services of 31 million, a 16 million lower year-on-year, reflecting black start payments received in 2016. It is noteworthy that in 2017 we created 88 million of value from system support services and flexibility, a combination of balancing market activities, ancillary services and advantage fuels. Now, with more intermittent and inflexible generation on the UK system and the removal of thermal generation, we expect the flexible and reliable attributes of our existing and new generation options to become an increasingly important and profit driver for the group. So, taken in aggregate, power generation EBITDA was up 37% on 2016. Energy supply, now a meaningful and growing part of the group's earnings profile, saw revenues increase from 1.3 billion in 2016 to 2 billion in 2017, and reported EBITDA of 29 million. This is in line with our guidance and an increase of 33 million on 2016. This increase reflects the acquisition of Opus Energy and the improved financial performance from Haven Power, which was ahead of plan. Now in the US, pellet production has made good progress, increasing volumes of wood pellets produced and sold, driving revenue growth and EBITDA of 6 million versus a 6 million loss in 2016. Raw fibre procurement, transportation and processing comprise the majority of cost of sales, and as such this remains an important area of focus and an opportunity. Through incremental investment in plant enhancements, we expect to see further benefits from efficiencies and greater utilisation of lower cost residues. Whilst total operating costs have increased, this is a reflection of an increase in operations in Amite, Morehouse and the Port of Baton Rouge, along with the addition of La Salle Bioenergy. With regards to La Salle, we expect growth in production and EBITDA over the next 12 months as this plant commissions. Lastly, to other, which is principally central costs and the elimination of intergroup balances, the increase reflected investment in strategy, innovation and development activities. Central costs going forward will be around 30 million per year. I just wanted to touch on earnings visibility, which is increasing in quality and reducing commodity price exposure. Our power generation business has index-linked revenues to 2027 under the CFD and ROC mechanisms. In 2017, these represented 37% of total power generation revenues, up from 23% in 2016. Combined with our long-term biomass procurement contracts and rolling 5-year FX hedging program, this provides a growing and predictable level of EBITDA, subject to maintaining high levels of operational performance. We have an important role to play in system support and expect this market to grow. Over the period 2017 to 2022, we expect to receive over 90 million of capacity payments. And any developments of new gas generation would be underpinned by a 15-year capacity agreement. Lastly, our energy supply business is profitable, providing predictable and growing sales in the B2B market and contributing to EBITDA growth. So to cash flow, where we delivered strong generation across the businesses driven by growth in EBITDA, most notably from the CFD mechanism. We also saw significant cash inflow from working capital totaling 148 million. Now, there are two components to this. Firstly, as a result of our third biomass unit transitioning from the ROC to the CFD scheme, we saw a reduction in the number of ROCs held on the balance sheet. We can face a meaningful delay between generating ROCs on the one hand and receiving the related cash compensation from the sales on the other, as compared to the CFD payments, which are settled on a monthly basis. The benefit of this change was a reduction of 112 million in ROCs held on the balance sheet. Secondly, we extended the utilisation of our Haven receivable facility, which we established in 2016, to enable us to sell power receivables to financial counterparties on a non-recourse basis, providing an excellent source of additional liquidity. Taking this together with debt service of 47 million and tax of 14 million gives net cash from operating activities of 315 million. Our current expectations for 2018 is a small outflow of working capital. After acquisitions, refinancing, capital investment, which I'll come on to next, and an increase in dividend payments, we had cash on hand of 222 million, with net debt of 367 million. Moving to investment, total asset additions for maintenance and improvements for the year were 133 million, in line with guidance, of which 69 million related to maintenance. We expect this to be around 50 to 60 million in future years, but recognising that this will vary from year to year, reflecting the needs of the businesses. Improvement and optimisation was 64 million, related to a number of projects which we expect to deliver significant incremental value across the businesses. Organically increasing the capacity of our pellet production, consolidating energy supply operations, and optimising power generation. Strategic investments includes our acquisition of Opus Energy for 367 million and 48 million for the acquisition and upgrade of La Salle Bioenergy, which is currently in commissioning. The latter was an attractively priced asset which, once fully operational, will increase capacity and support our strategic objective of good quality pellets at the lowest cost. Looking forward to 2018, we expect investment will be lower, in the region of 100 to 110 million, which includes 50 to 60 million of maintenance, 30 million associated with the development of the fourth biomass unit conversion, the balance being focused on investment and improvement projects which will support growth and deliver attractive returns. For example, enhancements to our generation assets, where we know that modest improvements to efficiency will deliver fast payback, and the development of our energy supply IT platform, which we expect to support growth and reduce our cost to serve customers. In pellet production, we continue to target a self-supply capacity of 30%, either organically or through acquisition, and to that end, we remain alert to sector opportunities. On to financing. We have demonstrated strong financial discipline. Our balance sheet is strong, and we have put in place the financial structures required to support growth with successful refinancing of 550 million of high-yield bonds, supported by a 315 million revolving credit facility, both extending to 2022, and providing for working capital, letters of credit, and commodity trading lines. At 31st of December, there are no amounts drawn on the central RCF. To date, our new arrangements have proved useful in supporting our trading strategies and reducing our long-term FX hedging costs. These are all components of the work we have done over the last few years to structure our business, financing and trading arrangements to operate successfully as a sub-investment grade entity. The bonds are rated BB+ by S&P and Fitch, a level we remain committed to and which is robust to low points in the cycle. As we have previously said, we remain focused on opportunities to optimise our balance sheet and the use of working capital across the group, which we believe is good discipline in driving returns on assets. So, to sum up, we have delivered a strong financial performance with increases in EBITDA and cash across the group. Higher quality earnings are coming through from the long-term renewable revenue under the CFD and ROC schemes, as well as in our energy supply business. We have put in place the financial structures to support growth, and at the same time, we have committed to delivering attractive returns to shareholders, whilst exercising cost and cash management. Looking forward, through 2018, we will continue to progress our strategy, and we will continue to implement opportunities identified to improve operations and profitability, reduce costs and CapEx, and optimise the use of working capital. I have provided some further guidance in the appendix, but with regards to EBITDA, current market consensus, and assuming good operational performance through the year, that remains sensible for 2018. And with that, I'll hand you back to Will.
Thank you, Dan. So I wanted to spend a little bit of time talking about how we are planning to deliver our strategy. And it starts with the context. The UK is transforming to a low-carbon economy. By 2050, it's legally bound to reduce carbon emissions by 80% across generation, transport, and heating. And the first step in this journey is the decarbonisation of the electricity sector, where substantial progress has been made. 2017 was a breakthrough year, as low-carbon energy sources, renewables and nuclear, provided 50% of power generation in the UK, while coal accounted for just 7% of the generation mix compared to 43% in 2012. Much of that new generation is wind and solar, but biomass has an important role. It is the only source of renewable power that can support the system, operating when the wind is not blowing and the sun is not shining. We expect the system to become increasingly volatile, with higher peak prices and lower, even negative prices at the bottom of the market. And this will create opportunities for flexible generators like Drax. Beyond 2027, biomass needs to become viable without government support, and that is one of Drax's long-term strategic goals. Finally, the low-carbon economy will require new solutions for transport and heat. And 2017 also felt like a breakthrough year for electric vehicles. While adoption is still low, enthusiasm is high, and it is an area that we are exploring with our business customers. A stable and secure energy system requires a range of different services, not just megawatts and megawatt hours. It requires low-carbon electricity and system support in the balancing, prompt, and ancillary services markets. Historically, this was provided by conventional plant, which meant that effectively system support came for free. Many of these assets are now coming to the ends of their operating lives and being replaced with intermittent renewables. To put it into context, over 13 years, 2012 to 2025, more than 30 gigawatts of coal and gas is expected to retire. That's 7 Drax power stations. This will lead to increased price volatility and insufficient system support. And as such, we believe that new gas will be required. And in the first instance, we believe that the low capital cost, fast response operating model of OCGTs is a good fit for the grid, meeting peak demand and providing ancillary services. So far, the capacity market has not brought forward the type of generation that will provide the security of supply, the flexibility, and the system support that's needed. The failure to develop the right sort of capacity will increase the need for action on the part of the system operator, and within 5 years, National Grid may be required to take corrective action in 60% of periods to manage the grid, to provide inertia and backup alongside the management of frequency and voltage issues. In this changing energy system, Drax's power generation business has an important role to play, both with our existing biomass generation as well as our new gas projects. With regards to biomass, we're very well positioned to provide ancillary services and system support. And as you know, during 2017, we secured government support to convert a 4th unit to biomass. We plan to complete the work on this unit as part of a major planned outage later this year. The investment required is around £30 million, making it a very low-cost solution. We will achieve this by utilizing older biomass infrastructure at the power station, which was built in 2010 for co-firing. We expect to run the unit at periods of high demand, which are often those of higher carbon intensity, supporting the system when it is most needed. While we will not receive a significant number of additional ROCs, by optimizing our running regime, we believe the investment will be attractive. This is an excellent solution for Drax, for government, and also for the consumer, and shows what can be achieved by collaboration between governments and industry. Over the longer term, we need to continue driving down the cost of biomass power generation. And it is our ambition to ultimately make it economically viable without government support. Beyond biomass, we're developing 4 options for OCGTs in central England and Wales. These assets can go from cold to full load in minutes, making them good support for intermittent renewables and also a source of ancillary services. We made excellent progress developing these projects during 2017, reducing our expected capital and operating costs. And we will continue to do more during 2018. We believe these are the right assets for the system and expect to enter the first 2 projects again in the capacity auctions later this year. Finally, with coal closure by 2025, we're developing options to repower our remaining coal units to run as CCGTs. We are currently going through a planning consultation process. No investment decision has been made at this stage, but we could participate in the capacity auctions as early as 2019, which could see one of those units on stream as early as 2023. And crucially, by using existing infrastructure, we expect the cost to be significantly below that of a new build CCGT. Having spoken about how our generation strategy takes advantage of our experience and position in the UK system to drive future growth and value, as well as having described our strategy for pellet production, growing to 30% self-supply, and using our position across the supply chain to deliver the lowest cost pellet, I now want to talk about our B2B energy supply business, Opus Energy and Haven Power. Our B2B annuity continues to strengthen, both by number of customers and value. Following the successful onboarding of Opus Energy, we're in a great position to leverage and grow our challenger brands. Today, we offer both great service as well as renewable propositions. And these are at the core of our offering and are driving growth. With the line blurring between generation and supply, we also have the opportunity to help customers on their own energy transformation. We now support over 20% of the UK's smaller generators, from wind farms to batteries to anaerobic digesters, gain access to the market, and we manage almost 2 terawatt-hours of renewable generation for our customers. And as we continue to grow and take advantage of the synergies between energy supply and generation, we have identifiable opportunities to strengthen our gross margin. This has started with our insourcing of gas and power and is already delivering benefits. Beyond that, we need to keep innovating. We recognize that customers are demanding more control and new ways to interact with suppliers, and we are responding. We've taken a digital-first approach to the design of all of our technology. Smart meters have been delayed in the industry as a whole, but our program is well underway and ready to accelerate once the meters become available. We see this as critical, as the data that smart meters will create becomes the catalyst for change with new ways to support customers with their energy efficiency propositions. And underpinning our overall B2B supply business will be our investment in technology. We are building a retail energy platform that can take advantage of a changing energy market. But we're not waiting. We're focusing on efficient operations today. Opus already has a very competitive cost to serve, and we are starting to apply that model across our supply business. So in summary, our plan is to continue growing market share as we segment our SME and I&C bases to deliver targeted products and services that meet our customers' needs. To leverage our group capabilities to grow gross margin and value, and to achieve leading cost to serve through an efficient operation, leading to predictable growth towards 80 million EBITDA by 2025. So finally, let me talk about our capital allocation policy. We are committed to making disciplined capital allocation decisions as well as driving operational excellence across the business. Let me remind you of the policy. We're committed to a strong balance sheet and credit rating, and we have defined that as having net debt to EBITDA of 2 times. We will continue to invest in our core business and to drive our strategy. And we expect to pay a sustainable and growing dividend, which was £50 million in 2017. At the half year, we will update you on our expectations for the next year, the 2018 dividend. And as we've said, if there is a build-up of capital beyond the group's investment needs and balance sheet requirements, the board is committed to returning this to shareholders using the most appropriate mechanism. And this informed our decision to initiate a £50 million share buyback program, and is a commitment from the board and from myself to deliver a strong balance sheet with investment in growth and significant returns to shareholders. So in summary, we have a strong business with growing EBITDA from all areas of the group. In pellet production, we are commissioning LaSalle as part of our self-supply strategy and optimizing production to produce good quality pellets at the lowest cost. In power generation, we are focused on running the power station safely, efficiently, and with high availability. We're developing a 4th biomass unit to provide additional long-term renewable revenues alongside system support. We continue to develop our gas projects and will enter our first 2 OCGTs in the auctions again in December. In B2B energy supply, we expect continued growth in meters and EBITDA from Opus and Haven, alongside the development of systems and platforms to support long-term growth and efficiency. Finally, we have delivered strong balance sheet management and demonstrated commitment to our capital allocation policy, with a £50 million dividend and a £50 million share buyback program. Overall, I think 2017 was an outstanding year for Drax. We made significant financial and strategic progress. In 2018, we are very focused on delivering our strategy and building shareholder value. And with that, we will take questions. So could I ask you to let us know who you are and where you are from, and then I'll direct the questions to the team here. Chris.
Good morning. Chris Labert, JP Morgan. Two questions for me, please. Just firstly, on the dividend, you're confident to deliver growth. Previously, Will, you talked about EBITDA growth and cash flow growth to link to the dividend, or there was a linkage that you mentioned. Is that still the case, and should that be the metrics that we should be looking at going forward? And secondly, just on capital management, net debt to EBITDA was well and truly below the 2x target this year. It looks like you could have extended the capital management further. For me, it looks conservative. Would you agree with that assertion over the 50 million capital management to date?
Okay, so on the dividend, I think the way that I want to think about that is that there is we have a plan for where we want to get to by 2025 in terms of EBITDA. I don't expect that to be linear. I mean, obviously, the investment programs will come in at different points in time. I would similarly expect that the dividend growth probably won't be linear, right? So while I would say in broad terms it would be fair to assume that those might grow at similar rates, I think it's probably, I wouldn't want to say sort of year on year I would expect the growth necessarily to be matching off, but sort of very much sort of broad-based long term, maybe yes, but not specifically year to year. In terms of the capital management, I think I would go back to the way really that we as a board sort of think through the process, right? So, I mean, it is every year we look at our plans, we look at our balance sheet, we look at the types of cash flows that we expect to come through, and we look at what we think the right return is for shareholders, and then we make a call as to what we think should be returned. So I think fundamentally 2017 was a good year, right? We had very good balance sheet management, and that obviously informed the decision, and we'll look at things in the same light at the end of next year and see where we go. Yeah. Mark.
Hi, it's Mark Freshney at Credit Suisse. Two questions. Firstly, on the capacity auction clearing price. I mean, it seems to have gone some way below £20 a kilowatt year, which is what I think you guys need for new entry. If we are in an environment where perpetually we get people bidding at zero and it doesn't clear above 20, what would be the plan B for capital deployment? What other areas could you go to without capacity auction support? And secondly, a question for Den on the balance sheet and invoice discounting. The ROC monetization facilities and I think the Haven facility, what was the total magnitude of those that was used, and did that contribute to working capital inflow?
Why don't I take the first one? I mean, I think fundamentally as we look out over time, it's, I think, hard for any of us to know sort of where and when, when I think we will know, but where that market will clear, right? I mean, clearly the market brought forth some interconnectors, brought forth some demand-side response, and it would be our view that in addition to those types of things, that the system does need new gas, right? And fundamentally, we think that the types of services that both our open cycles, but also the combined cycle can provide to the system, will be needed by the system, right? Again, over the course of the next few years, there is more coal to come off. There is some nuclear to come off, and the government, again, every year they set their demand requirements. So, to be frankly, I mean, we're going to see how those auctions come out. Again, we think that the system needs what we have to offer, and we'll sort of take it from there. Right. Dan, do you want to?
Yeah, on the Haven facility, the total facility is 150 million. We used 110 of it, and the kind of inflow was probably in the tens of millions for last year, working capital.
Yeah.
James Brown from Deutsche Bank. Just had a question on the pellet facilities. You made 6 million this year and obviously aiming for more than 75 million over the kind of 2025 target.
Yeah.
Can I ask, it kind of implies you should be making 30 to 40 maybe from the existing plants if we X out LaSalle. So the question is what's causing the low profitability? Is it phasing and you expect that to just ramp up over the next few years? Is it a transfer price issue or is it a return issue? And if it is phasing, over what kind of time period do you think we should be getting up to the 30 to 40 million or so of EBITDA?
Okay.
Thanks.
So I think so the way I think about it is that there are really sort of three drivers of additional future profitability there. So the first one is actually getting up to nameplate on a consistent basis, right? Because fundamentally, it's all the biggest driver of a lower unit cost is throughput, right? So that's the first thing that we need to achieve. Yeah. The second thing is there are, again, I would say these plants are relatively new, right? So there's still efficiencies that we're getting sort of throughout the process and sort of learning new ways to sort of deliver lower costs. So one of the things we talked about before, for example, is that the dies, effectively is a large roll through which you push the fiber that actually turns into pellets. They actually look very expensive, as much as 10,000 pounds a go. And we're looking, we've actually found ways to extend the operating life of those by, several turns, right? So that type of efficiency is the second thing we're looking at. The third thing is as we expand capacity and we use more sort of residues and sort of dry shavings, for example, right, the overall sort of cost of the fiber comes way down, right? So that brings our sort of marginal cost down, right? So I would expect it'll be over several years that I would look at this. I mean, first for the first two plants and then for the third. And we've talked before about 15 million plus or minus per plant, right? But that's what we expect. I would say over the next few years we would expect to get to that point.
Thanks.
Good morning, McLaren from Merrill's. Would you be able, please, to speak a little bit more about the fire at the end of last year? What happened? Might it have been a lot worse? And what have you learned from the experience?
Yes, should I ask Andy to take that question? Yeah.
Of course. So I think, as Will said, we had a small fire. This was located just outside the rail unloading building on our conveyoring system. So it was put out very quickly. It didn't last very long at all, and we've repaired the kit, and that was back on within 4 weeks. So what have we learnt? We have a very safe and reliable operation. I mean, this was the first major incident we'd had, putting 25 million tonnes of biomass through the plant. But I think it's fair to say we are handling a combustible material. And also, we've been doing this for 5 years. The experience on coal is obviously much longer. So there are continued improvements that we need to make. But our conclusion is that the design is good. We have a reliable operation. There are improvements we can make, and we don't expect there to be any change to our availability on the biomass units in the future.
Must be something more.
Verity Mitchell, HSBC. I was just very interested in the 88 million of flexible response. I mean, how do you see that going forward? I mean, is there a base you think you might be able to see being contributed every year? What number should we think about?
Andy, you want to take that?
Yep. So of the 88 million, around 30 million of that was we would call ancillary services, so the support that we provide to National Grid. And then the rest is made up of our trading optimization, so the near-term trading, and also the value we get from using advantage coals, so where we can use higher sulfur coals, we can use other coals that we can source in the UK. Now, clearly over time, we would expect that coal added value to come down, but we do expect the system to become more volatile and for ancillary services and trading revenues to go up. So we would think about something like a 70 million number going forward.
Is there anyone on the webcast? Any questions from there? Okay. Well, we are here. If you guys want to ask more questions offline, we'd be glad to take them. Thank you all for coming, and look forward to catching up more. Thanks, guys.